Hi, my name is Tony McLaughlin, and I'm speaking to Nic Carter, and we're going to be speaking about crypto assets. Hey, Nic, thanks for joining us today.
Thanks for having me on. It's my pleasure.
Hey, Nic, tell us a little bit about yourself, your firm, and the recent paper that you've written on crypto dollars.
So I work I'm a founder and general partner at a venture capital firm based in Boston, Massachusetts called Castle Island Ventures. And we invest in the public blockchain industry. So we invest in startups at the seed stage that are building in and around public blockchains, in particular at the intersection of public blockchains and financial infrastructure.
Hmm.
So it's our view that not only is there a new asset class being built out, but there's a new payments and settlement rails that's being built out.
Yeah.
And a really big part of that is the transmission of dollar denominated assets on these rails. So not just the transmission of things like Bitcoin and Ethereum, which you could call crypto native assets, but just
Yes.
the settlement and transmission of dollar denominated assets, which might be backed by dollars in bank accounts somewhere. And that's really been the big phenomenon of the last 12 months in the industry.
Hmm.
And in my opinion, the most dynamic and probably exciting thing that's happening right now is the growth of these so-called stable coins, or we call them crypto dollars, to make the kind of analogy to euro dollars, because they have some things in common. And so, yeah, we wrote a white paper about the phenomenon to basically make it clear that not only is this industry the growth of potentially new asset class with regards to these, crypto assets, but also there's a growth of the parallel financial infrastructure potentially, and that's what we wanted to shine the spotlight on.
And Nic, it's a fascinating paper. I'll include it in the comments below this video, and encourage everyone to read it. So maybe we can just get into it a little bit. And first of all, you said very pointedly public blockchain infrastructure. So let's get one thing out of the way to begin with, which is so maybe briefly touch on this. Why is your focus specifically public blockchain infrastructure compared to private permissioned? Is there something wrong with private permission that you don't like so much?
Well, if you look around at the things that I've written, I've definitely written a few things that are fairly critical of private blockchains. But our focus as a firm is exclusively on public blockchains. I certainly acknowledge that perhaps enterprise or permissioned or private blockchains could lead to maybe efficiencies in the back office for financial firms. To me, that's kind of an incremental move
Yeah.
forward and potentially way to update standards, which are maybe really outdated. So it's a potentially very important catalytic event in that context. But to me, the public blockchains are really the transformative phenomenon here.
Mm.
The permissionlessness is really key. The interoperability, the fact that anybody can build on them with no constraint or restriction is really important. And then fundamentally, an asset like Bitcoin, which we believe is potentially an important non-monetary savings device,
Mm.
that requires a public blockchain.
Yeah.
So that's why we mostly focus on public.
So, Nic, let's talk about your recent paper on crypto dollars. What is a crypto dollar and why is it different from a stable coin?
Sure, yeah. So I would say they're effectively the same thing. We've just we believe that this name is probably more appropriate and can probably take it further in the public consciousness. The name stablecoin emerged as a reaction to crypto assets like Bitcoin, which are super volatile. And it kind of connotes the fact that stablecoins were created as a way to create stable collateral for traders within the crypto ecosystem. But
Yes.
we think there's a much broader phenomenon occurring here, which is the injection of fiat currency into public blockchains and
Mm.
allowing these representations of, in fact, for the most part, dollars in bank accounts to circulate on public blockchains and to settle on them. And that's the thing that we really wanted to make reference to. So put simply, we define a crypto dollar as cryptographic tokens which circulate on public blockchains and aim to track the return of sovereign currencies.
Mm.
Now, we don't say that they're necessarily redeemable for fiat currencies because not all crypto dollars are. There are some projects which target the return profile of fiat currencies like the dollar without actually being backed by dollars.
Yes.
So I wanted to include that kind of nuance in the definition.
Yeah, and there's a whole family of these instruments that have been developed over the past number of months. And I guess it strikes me as being a little bit ironic, and maybe it wasn't the inventor of Bitcoin maybe didn't imagine this being a development where, I guess what he or she wanted was a kind of like global currency of the internet that would be completely separated from fiat currencies issued by governments. So it's a strange turn of events where this public blockchain infrastructure is now being used potentially for the tokenization of fiat currency, and even central banks are getting into the game with the potential issuance of central bank digital currencies. Not exactly what Satoshi Nakamoto had in mind when he invented Bitcoin.
Yeah, and Satoshi was clear that he or she or they did not want any dependency on the banking system or
Yes.
on central banks or sovereign currencies. And they actually touched on why the Bitcoin unit of account could not be the dollar in some of their earlier comments, because you needed a way to inject a price feed, for instance, which is difficult without a trusted third party. So yeah, Bitcoin is meant to be crypto native in that its value is just determined by the market. But yeah, I certainly acknowledge that there is a certain irony in the popularity of stablecoins, and maybe even more so in the fact that stablecoins are actually displacing the native units on some of these blockchains. So on Ethereum, for instance, which is the blockchain with the native unit being Ether, stablecoin transactions account for more settled value than Ether itself, than the native unit. So in some sense, they are actually parasitic, you might say, on top of these blockchains.
So these units, my understanding is that some of these famous, crypto dollars or stable coins, digitized dollars, whatever you want to call them, they grew up for a very specific use case, which is that traders, crypto traders, either wanted to arbitrage between exchanges, and some exchanges don't accept fiat, they only accept crypto because they can't get access to the banking system. Or maybe they just want to kind of like keep their powder dry and come out of crypto for trading purposes and wait to get back in. So is that correct? Was the initial use case that, and do you see that use case broadening?
Certain projects like Mastercoin, which was started in 2013, included a stated desire to create a stable value asset, using crypto collateral, which was then replicated with BitShares and then later on with Maker. So even before the emergence of stablecoins as an inter-exchange settlement mechanism, there has always been this kind of latent desire in the crypto community to create stable value tokens. So I wouldn't say it's solely attributable to traders needing alternative settlement rails for transacting with exchanges, but that's definitely why the first billion units of stablecoins or crypto dollars were created, was for that express purpose. So it only really took off in, I would say 2018, actually, late 2017, 2018, then there was a massive acceleration in early 2020 as well.
Yes.
And now the total outstanding number of crypto dollars is about 12 billion as of today. So it's really staggering from a standing start in 2017.
And how much of that 12 billion is backed by real dollars?
Well, the number one biggest project is Tether, with about $9.5 billion of outstanding capitalization. And there's historically been some controversy about how many actual dollars and bank accounts back Tether. So there's not a huge amount of transparency there. But for the most part, the most popular model is the fiat-backed model. So
yes,
over 90% is consists of the fiat-backed model, whereby in theory there are dollars in bank accounts. Although, again, the number one project has had issues with disclosure and transparency.
Yeah. So again, in your paper, you talk about that variety of different models in terms of how people achieve stability. And it also strikes me that this stablecoin development kind of tries to address an argument which is made by many economists that crypto doesn't fulfill the the definition of money because it can't operate as a stable means of exchange. And also, obviously, there's been some big tech movements in this space recently as well, which has stimulated a bunch of developments. So you're saying that these crypto dollars, they're not always backed one-to-one by dollars held in bank accounts and commercial bank accounts. What are the other ways that crypto dollars seek to maintain stability?
There's some pretty exotic asset portfolios backing stablecoins or crypto dollars. Aside from backing them simply with liquid instruments like dollars, the second most popular approach involves actually over collateralizing a basket of native crypto assets and using that plus kind of an interest rate policy to target a dollar peg. So this is the way that MakerDAI, which is the most popular system in that category, does it.
Yes.
It's worth noting that that is that's more capital inefficient to create, right? And there is a risk there because you have now this risky, volatile collateral that you're trying to use to create a stable output. And so it's more complex. There's more risks. There have been some failures there, some bugs. And so there are many fewer crypto dollars of that variety that exist. However, the crypto industry participants tend to like that model better because it entails using cryptocurrencies as collateral, which creates a reservation demand for the cryptocurrencies. So it's kind of more aligned in terms of creating a dollar stable asset.
Interesting. So I'd like to talk about the potential for crypto dollars to move out from its initial use case and being used for normal payments or as a savings vehicle or for some other use cases. What's the prospect of that? You've said that crypto dollars have experienced a massive growth from a standing start, but that's kind of like within the crypto community. What's the potential for crypto dollars to address other types of financial needs?
Sure, yeah. So it's kind of difficult to measure the usage of crypto dollars in a transactional context in terms with respect to the kind of transactions that are being made, because there's very little metadata collected, right? Public blockchain transactions are pseudonymous. So there's a definite challenge in terms of identifying what people are actually using them for. But currently they settle about $2 billion a day. And the vast majority of that will be traders settling with exchanges and using crypto dollars as margin on exchanges.
Yes.
The largest crypto dollar project, Tether, has effectively become the main reference currency and the numeraire for a lot of these financial products and derivatives on crypto exchanges. So it's definitely the native currency of the crypto financial institution alongside of the crypto financial industry alongside Bitcoin. There are some reports that it's been used in kind of gray markets for export businesses where there might be capital controls present. Again, it's hard to collect data on that. I would say, though, that there is a definite shift towards encouraging the usage of crypto dollars for regular old settlement that you might otherwise rely on bank wires for. So
like remittances?
Remittances is certainly one, and there are definitely projects that are relying on them, in particular in places like Latin America, to encourage the usage of crypto dollars there. Because what that allows you to do is get exposure to the dollar in a context where you might not otherwise have the ability to get that exposure. And so there's there's several projects that I know of that are targeting the Colombia-Venezuela corridor for remittances and for a savings device, for a dollar-denominated savings device. So you could see that there'd be an intersection with some of the dollarization movements happening in Latin America as these sovereign currencies potentially fail or experience significant inflation.
And look, another question is, with central banks considering central bank digital currencies, which is essentially the tokenization of a national currency. If that happens, doesn't that kind of blow crypto dollars out of the market, because a central bank digital currency would be backed by the full faith and credit of the sovereign state? So why would I use a private crypto dollar if there's a public crypto dollar?
It's a great question, and it kind of takes us back to the distinction between privately issued money and state money. So lots of people just fundamentally have a preference for privately issued money. I know that's not really a big topic these days, but you can think back to the free banking era in, for instance, in Scotland, as a time when, or a demonstration of the success of sort of commercially issued money. I would say just fundamentally, crypto dollars as they exist today are really unencumbered. So they grant you a level of transactional autonomy and potentially transactional privacy, which are kind of unmatched in a digital context today. That might change, of course. The FATF has come out with a report on stable coins, and maybe FinCEN and the various regulatory agencies will try to curb their usage. But that's the vector that they distinguish themselves on, is replicating the characteristics of physical cash in a digital context, which I would say doesn't really exist today outside of the crypto dollar industry. For the most part, the financial industry there's a lot of metadata spun off there. There's a third-party doctrine. So in the US, you don't have no assurances of transactional privacy now. A lot of people will take that as a negative and say, well, we need the financial system to be wholly transparent. I think fundamentally there's just disagreement on that front in terms of the degree. I think it's understood. My interpretation of the CBDC projects in the US is that there would be limited amounts of privacy. And I think the government would probably be able to collect, arbitrary amounts of data on their usage. So these actually distinguish themselves in a different dimension. I actually don't think they compete directly with CBDCs, even if they kind of look cosmetically similar.
But you did mention FATF, and the kind of FATF recommendations are that essentially the exchanges, the virtual asset service providers, will have to pass between each other information about the sender and the receiver of the payment, so that pseudonymous attribute may disappear.
Perhaps, and it's not clear to the extent to which virtual asset service providers or exchanges, what they will actually have to do to comply here. Because the travel rule, for instance, there hasn't really been a complete understanding of how that would technologically be implemented for a blockchain transaction. So there's still uncertainty there. The other thing I would say is that crypto dollars increasingly are being used in a closed loop way, in which recipients of crypto dollars don't really seek to redeem them for actual dollars that they might be backed by. They can just use them in a transactional context that maybe they're not having a lot of touch points with the actual financial system, right? Or the banks that back these assets.
Yes.
So given that they're accepted as dollar substitutes, you can have the transactional graph with only the edges of which are surveilled and have these kind of KYC obligations. And then the internals of that transactional graph, which might be many hops, you have more kind of privacy guarantees there. So that's the doctrine of permission pseudonymity is what
I see. So you're
saying that.
I see. So you're saying that the interactions with the exchanges will be subject to those types of rules, but the person-to-person transfer of those assets obviously will not be. So I see that point.
That's the way it works today, effectively. Again, maybe the FATF says, okay, well, we totally hate that, and we're going to enforce a switch to a whitelist model as opposed to a blacklist model, which is how they work today.
So I'd just like to end by asking you to kind of reflect on this, Bitcoin journey that you've been on for quite some time, and it's certainly gone through a number of twists and turns since the original Bitcoin white paper was released. And again, I do think there's a certain amount of irony in the fact that we're now talking about digitizing fiat currencies on public blockchains, central bankers issuing their own currencies on blockchains, and big technology companies making use of this kind of technology as well, all of which potentially would have Nakamoto not particularly happy. So, where do you think we've reached in the kind of legitimization of, public blockchain crypto assets as being kind of getting a bit closer to the mainstream. And I guess my question is, do you think that COVID, which everyone says accelerates digitization, it's kind of like a normal thing to say these days. Does COVID accelerate the acceptance of crypto, the legitimization of crypto, or not?
I think so, both from the obvious context that, in which crypto is a virtual industry and the infrastructure is virtual and is more highly automated than kind of standard back office infrastructure. And then in the derivative sense that COVID has catalyzed pretty unprecedented monetary behavior from all of the major developed sovereigns. And in my view, that's a legitimation of these non-state monetary assets which exist, like Bitcoin. And I don't see a huge tension in the growth of stable coins and the continued growth of Bitcoin. I think for the most part, they're mutualistic. So I would say crypto dollars vindicate the crypto financial infrastructure which emerged to service Bitcoin and other crypto assets.
Yeah.
That's why crypto dollars are possible, because there's these exchanges that are fiat on and off ramps into the crypto ecosystem in virtually every country. And there have actually been some key regulatory wins in places like India and South Korea where exchanges were banned and then were unbanned subsequently, in some cases with Supreme Court decisions. The other thing is that they rely on this notion of storing value as public keys. And that's also a relatively new concept, I would say introduced by Bitcoin, although there have been other public key infrastructures in the past. And this is definitely the largest scale usage of that technology, which is very much a function of the fact that it was normalized through the growth of just regular old cryptocurrency.
Yeah.
And as I mentioned, there are some models which employ this native crypto collateral as the basis of the system, the same way that free banks used gold as the basis of their system. So I think there's always a role to play for liability-free collateral, which has value simply because the market decrees it so, and not because there's a guarantor of sorts. So I think for the most part, it's mutualistic. I know that might be a motivated answer, but they seem to be going hand in hand as far as
yeah. So in other words, there's no irony whatsoever, because all of these developments just fundamentally supports the core Bitcoin thesis, and all of these other projects will come and go, and Bitcoin will remain standing in the end. Is that the idea?
Well, if there are really adverse outcomes with the fiat-backed stablecoins, which is entirely possible, that does vindicate the more trustless and decentralized model proposed by Bitcoin. Of course, people prefer to transact with stablecoins. So I think what's going to happen is actually we're going to see an ebb and flow, basically, between the more convenient usage of this blockchain infrastructure in a dollar-denominated manner, and then potentially contraction as regulators extract their pound of flesh. And then you'll kind of move down the hierarchy back to the more trustless assets like Bitcoin. But I don't think anyone's enthusiasm to transact in a crypto context is going to be diminished anytime soon. I think the value proposition has really been demonstrated, and I think the need for an alternative financial infrastructure is very clear, as is the need for non-state monetary goods.
Well, Nic, I highly recommend that everyone reads your paper. It's extremely articulate, well written, and educational. And I want to thank you very much for spending time with us today.
Thanks for having me on. I appreciate it.
Thank you, Nic.